Good afternoon, everyone. My name is Gareth McLeanan. I'm the convener of the Ulster Chartered Accountants Society Charity and Not-for-Profit Committee. Firstly, I want to thank everyone for taking the time out today to join us for this webinar. I know we're in the run-up to Christmas, but we're delighted to have Mike O'Halloran here today to present on the Charities SORP. The Charities SORP 2026, released earlier in the year, October 25, sets out a new framework aimed at enhancing transparency and better reflecting the wide range of charity sizes and structures. Today, Mike will speak for about 45 minutes. Hopefully you have read Mike's background and information, but fair to say that he knows what he's talking about and hopefully will give us some very, very useful information on the SORP. So without further ado, I'll pass you across to Mike.
Thanks very much, Gareth, and thanks for the introduction as well. Hello to everyone. Great to be here today, and thanks for inviting me on here today. It's great to speak to everyone, and I appreciate it. It's a very busy time for everybody as everybody's trying to get finished up before the Christmas. So we're here for the next hour or so, and we're going to delve into the Charities SORP 2026. The SORP appeared on the 31st of October, so it's been live now for 6 or 7 weeks. There are some pretty significant changes for charities who are applying the SORP, and we'll go through some of the key changes over the course of the next hour. I suppose before we start, just to flag, that's our usual disclaimer that goes out with our slides. I suppose before we get into the detail properly, by way of introduction, as Gareth's already introduced me, my name is Mike O'Halloran, and I'm here today from the professional accounting team in Chartered Accountants Ireland. So we're responsible for the technical output, things like technical alerts, technical releases, news items. We've a roundup newsletter that goes out every 2 weeks, and various other matters of relevance to accountants on the technical side. We've quite a wide remit. We cover things like financial reporting, which is the main focus of today's session, but also audit, business law, company law, AML, insolvency, sanctions, sustainability, and a few other areas as well. And that's across both the Republic of Ireland and Northern Ireland as well. So when you get the slides, there is a link on this slide to our technical hub. So do pay it a visit, and if you have any feedback on it, please do share it with us. We're always keen to hear feedback as regards what's on our technical hub, and if there's anything you think we could cover, by all means do let us know. So the focus of today's session is the Charities SORP 2026. So we're going to go through just a background to the SORP, where it came from, why we need to apply it, and what it's all about. We're going to look at some of the key areas then that have changed in the 2026 version. So we're going to focus in on the Trustees annual reports, revenue recognition, leasing, and a few other areas as well. And we're going to finish then just by discussing how to prepare for implementation and how you can be best positioned to make sure you're ready for the changes when they come down the track. I suppose just to briefly touch on the charity sector in Northern Ireland and the Republic of Ireland. So in Northern Ireland, there's, I think, close to 7,500 charities. For those 7,500 charities, many of those will be required to report under the SORP, particularly if they're a company and are required to prepare accruals accounts. And even if they're not a company, if you breach the income threshold, you're required also to prepare SORP accounts. So in the Republic of Ireland, then, there's approximately 11,500 charities, and there's no mandated use of the SORP for ROI charities yet. And I suppose yet being a key word there, I know that's an area that the charities regulator in the Republic of Ireland is looking into at the moment. But notwithstanding that, some charities do voluntarily prepare SORP accounts for whatever reason. They might have a funder or a beneficiary or the trustees might voluntarily want to apply the SORPs, apply the SORP, and for many reasons, charities in the Republic of Ireland would voluntarily prepare accounts on the SORP. So what is a SORP? I know we've only got an hour here to 2 o'clock, and I know we'll try and get everyone back to their desks as within that time frame. There's a quote on the screen which is coming from the FRC website. So the FRC is the Financial Reporting Council, as regards what a SORP is. I guess it's essentially it's not a standard, but it is a series of recommendations as to how you might apply the underlying standard. So when we talk about the underlying standard here, we're talking about FRS 102, and the Charity SORP explains how a charity who is required to apply FRS 102 would apply those recommendations, given the fact that it's operating as a charity and has, I guess, specific circumstances that are often quite common to charities. In terms of the overall framework, there's more than one SORP. There's 7 of them currently in issue by the Financial Reporting Council. So there's 7 SORP making bodies. The Financial Reporting Council oversee all of the standard setting and the updates that are provided, but they don't write the standards. The standards are written by the SORP making body, but before the standard is issued, it must carry a statement from the FRC, just to say that there's no unacceptable points of principle contained in the SORP, that there's no conflict with the underlying standards of FRS 102 in the SORP, and that it doesn't undermine the FRC's broader objectives. So once those criteria are satisfied, then the FRC are happy for the SORP making body to issue the standard. And just if you're keeping score on the 7 SORP making bodies, of the 7 SORPs that we're expecting to see issued this year, because all these SORPs are trying to keep track with the FRS 102 updates, we currently have 4 that have been issued by the SORP making bodies. So we have a Charity SORP, an LLP SORP, a Further and Higher Education SORP, and an Authorised Fund SORP that have been issued in the last couple of months. And we'll likely see before the end of the year a Pension SORP, a Register of Providers of Social Housing SORP, and an Investment Trust Companies and Venture Capital Trusts SORP. So, I mean, out of all of those, I guess the Charity SORP is probably the most commonly used and the most relevant to a lot of people, but the other SORPs might also be of relevance depending on your client base. And I suppose if we look at the background to the Charity SORP 2026, so this is the 3rd version of the FRS 102 Charity SORP. It did exist before FRS 102, but this is the 3rd version of the SORP that addresses FRS 102. So we had a 2014 version, a 2019 version, and now a 2026 version. The role of FRS 102 in applying the SORP, well, the standard is anchored on FRS 102. So FRS 102 sets the accounting standards. The SORP can't really deviate from a requirement laid down by FRS 102, but it can provide guidance and it can add additional disclosures. So I guess the reason we're here is the 2024 periodic review of FRS 102, and that was the 2nd periodic review, brought with it quite a bit of change, notably in relation to revenue recognition and leasing. And we'll speak about those and how they might apply to charities as we go through the slides. Then in 2025, there was a consultation on the Charity SORP. There was over 100 responses to that, including a response from ourselves in the Institute, and I've linked that on the slides for when you get your slides, if you want to have a read of the representation that we would have made in relation to that. The effective date, that's important, and it's, I suppose, just because we're talking about a new SORP, it doesn't mean that the old SORP is immediately put in the bin. The effective date for this is periods commencing on or after 1 January 2026. So the 2019 SORP will still be used for periods commencing before the 1st of January 2026. So it might still be, or certainly will still be relevant for at least one more financial year, just depending on when your year commences. Early adoption is an option, and that comes with the usual caveat that you can early adopt, provided you adopt all of the provisions, so that you don't pick and choose which provisions of the SORP you adopt, that you adopt the full remit of the SORP. And also just to flag that there are some significant changes to disclosure, to measurement, to recognition, that there will be substantial changes to the figures that are reported, the disclosures that are made, and how your set of accounts will look based on that. A couple of concepts just built into the SORP. So as I've already mentioned, the SORP can't contradict FRS 102, but it can provide guidance. It can limit accounting policy options, and when we look at government grants, the SORP has always limited the accounting policy choice on that, and the requirement under the SORP is to use the performance model as opposed to having a choice between the performance and the accruals model. And it can also override any exemptions. So if FRS 102 offers an exemption for whatever reason, the SORP can also override that exemption, and it can also add disclosure requirements, which I guess is most commonly seen in the Trustee's annual report, where there's quite a lot of additional information to disclose for charities applying the SORP, as opposed to companies applying FRS 102. There's a news item that I've linked on this slide when you get the slides, and that is it's quite a short piece, but it was issued jointly by the charity regulators in Northern Ireland, England, Wales, and Scotland. And this was just before they published the SORP, and it kind of just sets out what they can and can't do when they are writing the SORP. So I mean, they can't override certain provisions, as we've already mentioned, but it just goes through some of the things they can and they can't do. So it's a useful read. It's a very short news piece, but it's worth having a look at. So the terminologies in the SORP is also very important. So you'll see dotted throughout the SORP, there's a mention of must disclosures, should disclosures, and may disclosures. And the distinction is very important when those words are used. And obviously must is a required disclosure, should is somewhat best practice, and may is an optional disclosure. So it's just it's important when you see references to those three words just to to obviously treat them accordingly. And when we get into tiering, a lot of there's some distinctions for lower tiers, so tier 1 companies to tier 3, whereby a must disclosure under tier 3 might be a should disclosure under tier 1, etc. The SORP disclosures aren't exhaustive, so just because you've disclosed everything required in the SORP, you might still have to look at company law requirements, you might still have to look at FRS 102, you might have to look at the true and fair view requirement and whether the disclosures are appropriate in that regard. So they're not exhaustive. And where there's a conflict with FRS 102, well, FRS 102 will trump the SORP in that the requirements of FRS 102 will follow through. So I suppose onto the key changes under the 2026 version. I guess the first key change is in relation to tiering. So previously there was an element of tiering in that there was a concept of a larger charity, which was a charity with income of greater than 500,000. And previously charities who were classed as larger charities had additional disclosure requirements under the SORP. And that concept still remains, but the difference in this SORP is that there's now 3 tiers. So the first tier is charities with income of up to 500,000, and that's both pounds and euros. So 500,000 pounds, 500,000 euros. Tier 2 then is 500,000 to 15 million, and then tier 3 is anything falling above tier 2. So the whole idea of this is that there's proportionate disclosures, that it's kind of that you gradually increase the requirements as the charities get larger and ultimately more complex. Tiering actually only affects a very small number of modules, so you have only 5 modules will be impacted by tiering. So most of the modules are unaffected. But module 1 on the trustees annual report, there's significant differences there between the tier 1, tier 2, and tier 3 charity, particularly if a charity falls within tier 1, a disclosure might be a should disclosure, or it might be a must disclosure if it's in tier 3. In relation to sustainability reporting and things like that, there's additional disclosures for tier 3 charities. Module 4 then, that deals with the statement of financial activities and the templates that you can use. If you're in tier 1, you have a bit of optionality there. If you're in tiers 2 and 3, you have a mandated template that you must use. Modules 8 and 9 then, they're kind of linked to module 4, and they follow on from the templates that are driven by module 4. And then in module 14, then there's a useful exemption from the requirement to prepare a cash flow statement that is based on the company's tiering. So if you fall within tier 3, but we'll discuss that as we go through the slides. So onto the trustees annual report. It's as people will be well aware, I'm sure it's a key document within a set of SORP accounts. It provides a narrative account of the charity's activities. So whilst the primary financial statements will explain the profits and the surplus or the deficit or the state of the company's assets, the trustees annual report will explain the story behind the numbers, and it'll bring a narrative account of the charity's activities to the fore. It'll explain the activities, the KPIs, what are your objectives, what are your goals, how do you strive to, what do you do in order to achieve those objectives and goals, and how do you manage that whole process. So it's a key document. It should never be boilerplate. And one of the things that the changes in the 2026 SORP tries to do is just to give charity trustees the tools they need in order to make sure that their story is unique to them And there are some prompt questions included in that, which will be very helpful, which we'll go through. So the Trustees Annual Report Module 1 has been largely rewritten and restructured to clarify the requirements. So there's a little bit more cross-referencing within the standard. There's also a tiering table, which is very useful. That kind of gives you a signpost. Well, if you're a tier 1 company, you go to this section. If you're a tier 2, you go to this section, and so on and so forth. So hopefully it should be a lot easier to navigate. There's a real focus on linking the narrative to the financials. So where you're reporting on a certain figure in the where you're talking about a certain aspect, you might have reported income of, I don't know, 2 million. Well, you should link the narrative in your Trustees Annual Report to that income, and you're not just focusing on a small portion of that you're kind of given a balanced view of what happened in the charity, not just a narrow view. There's also some general disclosure requirements which are replaced with prompt questions, which we'll come to in the next slide or two. And the definition of reserves is now included in the SORP as well. So that has previously not been included in the 2019 version. Legacy income can be challenging for a charity, and when we're talking about legacy income, we're obviously talking about somebody who leaves a portion of their estate to a charity for when they pass away, and that can be challenging to account for in terms of the point at which you'd recognise the revenue. It can be difficult to measure up to a certain point, and it can, there can be various legal implications as well that can be challenging. In relation to the Trustees Annual Report, there's now a requirement to disclose the impact of legacy income that's been recognised in the accounts prior to those resources actually being received. So if you have legacy income and it's met the revenue recognition criteria, but you just haven't received those funds yet, there's now a requirement to explain the nature of that, and I suppose when you expect to receive the resources. There's now an explicit requirement to provide the name of the auditors. So I think you'd be doing well not to find the name of your auditors in your annual report, but there's now a requirement to provide the name of the auditors in your Trustees Annual Report. Sustainability reporting is one of the big additional areas that's been brought into the Trustees Annual Report. So there's now a requirement to explain how a charity is responding to ESG matters. And as I've already mentioned, that is done with the benefit of tiering. And if you're a tier 1 charity, I think if you're a tier 1 and a tier 2 charity, that is a should disclosure. Whereas if you're a tier 3 charity with income over 15 million, there's now a requirement to disclose those. So I guess there's lots of things that charities might want to disclose in that regard. I mean, if you're subject to environmental risks, if you've got activities in developing countries or in island nations, or even if you have local environmental issues, if you're working out of an office that is potentially on a floodplain, how are you addressing those risks in the charity? And not to forget as well the S and the G, so environmental, social and governance. So how do you deal with things like staff welfare? How do you deal with things like data protection? How do you deal with governance in your charity? So there's a requirement now to explain how you're responding to those risks. There's an exemption from disclosing the names of certain staff or addresses or the principal place of business for charities, and this is thankfully it's an exemption that isn't taken very often. And I guess the background to this is where you have a particular charity who's operating in a certain area, whereby the disclosure of certain staff might put them or the disclosure of the names of certain staff or of the CEO might put them in personal danger. And I think the example that the SORP uses is the example of a women's refuge, and where you have a situation whereby you feel that it might put certain staff members at risk, or if you put the address of their principal place of business at risk, you're no longer required to disclose those names. Well, previously you didn't have to disclose it, but you had to explain the reason why you took the exemption, and the change under the SORP is that you're no longer required to explain why you're taking the exemption. And sometimes, depending on the jurisdiction you're in, you might need to get regulator approval before you avail of that exemption, but you don't have to explain it in your Trustees Annual Report. There's also some additional disclosures about the role of volunteers, and the SORP now has some guidance just that help to explain the role that volunteer groups play, and there's some proportional disclosures depending on what tier you fall into in relation to the important role that volunteers play when they do volunteer work for your charity. Impact reporting, this is a key theme in the SORP, and certainly in Module 1 of the SORP. There's a real focus on the charity explaining the impact it makes. How does it improve the lives of its beneficiaries? How does it serve its charitable purpose? And there's a real focus on communicating those benefits that are being provided to the beneficiaries. And one of the ways in which that's done is by including some prompt questions in Module 1. And I guess the whole focus of these is if a trustee was to sit down and answer all of these questions, what story would that tell of the charity? So, who are the users of our reports? Who actually read our reports? What are their information needs? What are our aims and objectives? How have we performed against those stated aims and objectives? Our significant activities, what do they contribute to our overall aims and objectives? And there's a load of questions throughout Module 1, which I guess are just prompts for you to tell your story. And I think they could be very beneficial, and certainly if trustees to a charity were to sit down and go through these questions, it definitely would provide a lot of very useful, very unique narrative reporting that is bespoke to the charity and tells its story in a meaningful way. So modules, going concern is covered in modules 1 and 3. So there's additional requirements in relation to going concern. So there's enhanced going concern disclosures compared to the previous version. So unfortunately, some charities will, whilst they mightn't have a going concern, whilst they might still be operating as a going concern, many charities will have a material uncertainty hanging over them, sometimes in relation to maybe a funding issue, or that funding isn't guaranteed when the accounts are being signed off. And where there's a material uncertainty in place, the nature of that material uncertainty must be disclosed. So previously that was a should disclose. That's now been elevated to a must disclosure, which I guess is it's hard to say you're giving a true and fair view if you're not explaining that. So I think that's a sensible enough move. Reserves. So if you've no reserves or negative reserves, which in a charity situation would be quite concerning, you must explain why you're still operating as a going concern. Going concern considerations, they're now directly incorporated into disclosures regarding plans for future periods. So it's specifically required to be considered as part of your going concern, or as part of your consideration of plans for the future periods. There's also a requirement to disclose any significant going concern judgments, and as well as that, the charity must also confirm that it's considered at least 12 months of information when it's made its going concern assessment. Right, on to module 4. I'm not sure, Gareth, if there's any questions that have come in. I'm happy to take them. No, I'll keep motoring on. So module 4 then deals with your statement of financial activities. And I've mentioned tiering already, and this is one where tiering comes into it. So tier 1 charities, they can apply the natural classification method. So can being a keyword there, because they have an option to apply the activity-based method as well. So if you're a tier 1 charity with income of up to 500,000, you can apply the natural classification method, and that's a template of it, which is coming directly from the SORP. Tiers 2 and 3 then must apply the activity basis, and again, there's a template of that in the SORP as well. Right, so the big ticket items when we're looking at FRS 102, which anybody who's familiar with, well, I'm sure a lot of people here will be familiar with the FRS 102 changes that are coming down the tracks. The two big ticket items were in relation to revenue recognition and lease accounting. So as the SORP has to mirror the requirements of FRS 102, there's a requirement that those new rules are incorporated into the SORP. So in relation to revenue recognition, module 5 is where you'll find all of the requirements in relation to that. There's one important distinction to be made, which I guess it's very important to establish at the start when you're trying to account for your revenue recognition. Are you dealing with an exchange transaction or a non-exchange transaction? Because depending on whether you're dealing with an exchange transaction or a non-exchange transaction, you'll have very different rules to follow. So module 5 has been updated, and that's been split into 2 sections. So section 1 will deal with exchange transactions, and that deals with the 5-step model. which we'll speak about in a couple of slides' time. And that looks at how that 5-step model might apply to charities. Section 2 then deals with non-exchange transactions, and the important point to consider when you're dealing with a non-exchange transaction are your performance-related conditions. So if we were to look at, well, what's actually the difference between an exchange and a non-exchange transaction? Well, the difference, I guess, is in the name, in that in an exchange transaction, somebody is giving us money and we're giving whoever gave us the money something back in return. So the example is up on the screen. So income from goods or services that are supplied under contracts with third parties. So for example, an income from a local authority under an agreement to provide residential care services. You might also have grant income received where the grant maker receives goods or services and there's a contract then in place between both parties. You might also have the example of the likes of a charity shop whereby you have a coat on the shelf. Somebody comes in, they see the coat on the shelf, they buy it, and there's an exchange of money for the coat. Non-exchange transactions then, and I guess given the time of year we're in, if you walk down any main street, you're likely to see people out shaking buckets, collecting money for whatever good cause they're collecting money for. And a non-exchange transaction, that's a good example of it. So somebody puts money in the bucket, they don't expect anything back in return. It's just a donation, and that would be classed as a non-exchange transaction. So there's a couple of examples of non-exchange transactions on the screen. So grant income received where the grant maker doesn't receive equal value in exchange, and legacy income, which is that's certainly a non-exchange transaction. So somebody leaving money in their will, and obviously they don't expect to get anything in return for that. So that's an important distinction. So if we're looking at exchange transactions, we're going down the route of the 5-step model of revenue recognition. If we're looking at non-exchange transactions, well, then we need to consider the specific performance-related conditions attached, if any. Quite often there will be no performance-related conditions attached to non-exchange transactions. So the 5-step model, and this is a key part of FRS 102, and by extension a key part of the SORP when we're accounting for revenue. There's 5 steps, as the name might suggest, and the focus here is to bring your source of income through these 5 steps, and at the end of these 5 steps you should have a means by which you can account for your revenue. So step 1, you identify the presence of a contract with a third party, and I guess contract is it doesn't have to be a signed written contract. It might just be implied, or if we use the example of somebody walking into a shop, well, the contract there is implied because something is up on the shelf and you exchange money for that, and that's your contract for step 1 purposes. Step 2, we look at, well, what are the performance obligations in the contract? What are we required to do in order to receive our money? Step 3, then determine the transaction price. What's the price we're quoting for the goods? Step 4, then allocate the transaction price to the performance obligations in the contract. This can be quite easy, depending on how many performance obligations are in the contract. If there's only one performance obligation, it's quite easy to account for it. If there's multiple, then you get into a situation whereby you have to determine, okay, well, what are the individual obligations in the contract, and how do we apportion the price of the price that we're getting to those individual performance obligations. And step 5, then recognize revenue when or as the charity satisfies a performance obligation. When we're dealing with non-exchange transactions, then what's important are the performance-related conditions. So if we have performance-related conditions, or sorry, if there's no performance-related conditions imposed, then we recognise our income when the resources are received or receivable. But if there are performance-related conditions imposed, well, then we recognise them in income only when the performance-related conditions are satisfied. And again, you might often find that there are no performance-related conditions, in which case we recognise the income immediately. But if there are, well, then we need to consider, okay, well, what are the conditions that we're required to do before we are that are a condition of receiving these funds. And when you have resources received before those conditions are met, well, you must hold the balance as a liability on your balance sheet. I've already spoken about legacies, and there's also a few additional disclosure requirements within the SORP that have come from FRS 102. Just before I move on to leasing, happy to take any questions, Gareth, if there's any in there. Happy to move on as well.
all I was going to ask, Mike, was would there be an example of a specific future performance related condition?
Yeah. You mean a performance obligation?
Yes.
Yeah. Yeah. So as I say, that this process can be quite straightforward. And if we were to use the example of somebody coming into a charity shop and buying a coat or buying a dress, step one, we identify, well, what's our contract with the customer? Well, they're going to come out of the shop with a coat, and they're going to give us £20 or whatever they're going to give us. What's our performance obligation? Well, we have to give them the product. What's the transaction price? Well, that's how much they hand over to us in order to get it. Then we allocate the transaction price to the performance obligations, which is quite straightforward because in this situation, we've only got one performance obligation. And in that situation, it's quite easy to recognize the income. I guess where it can get a bit more challenging is where you might have multiple performance obligations in a contract. So I think one of the examples on this slide is income from a local authority to provide residential care services. So, you might be a charity getting, I don't know, to name a figure, getting £100,000 a month from the local authority, which on the face of it looks like you're getting £100,000 that you recognise each month. But equally then within the contract, you might have to provide residential services, you might have to provide meals, you might have to provide, day sessions, physiotherapy sessions, whatever are the requirements of the contract. And in that situation, step two could be quite difficult in that you need to dig into the detail. And with all these things, the devil is in the detail as to, well, what have we actually agreed to provide for our money? Are we just getting this for straight 100,000 a month that is just for residential services, or are there other services built into it? So then in that situation, you might have to separate out a couple of performance obligations in the contract and then allocate that transaction price, which can be challenging, and would require a bit of analysis of, well, what's our contract with the person providing the funds here.
Okay, thanks.
No problem. So on to leasing, and it's the second big ticket item from the FRS 102 periodic review. And when we're talking about leasing, the main focus of what we're talking about is in relation to lessee accounting. So that's an important distinction, because lessor accounting is largely unchanged from what was previously the case. So what we're looking at here is purely the lessee accounting. So if we were leasing a property, our lessee is our tenant and our lessor is our landlord. So we're purely looking at it from the tenant's side. So for lessee accounting, there's been a removal of the operating versus finance lease distinction, and anybody applying FRS 102 currently, or the current version of the SORP, will be familiar that when we have a lease, the first thing we do is we carry out all of our our various questions, and usually at the end of that, it'll be very clear whether the lease is an operating lease or a finance lease. So the new version of the SORP and the new version of FRS 102 remove this distinction, and the new SORP module 10b will address this. So most leases will be brought onto the balance sheet, and there's a few exemptions to that, which we'll go through as we're going through the slides, notably short-term leases and leases of a low value. And as I've mentioned, lessor accounting is largely unchanged from what we previously would have encountered. But the module 10b, that looks at, well, what does this all mean for charities? And it looks at various leasing situations for charities. I guess charities are somewhat unique in that there's certain lease types that might be more prevalent in charities, particularly when we get into the area of peppercorn leases, social donation leases, and leases whereby you might not be paying the full market value for that. There's a flow chart which I'm going to go through in the next slide. The SORP making body have also mentioned that they're going to release 2 new help sheets. I haven't seen those yet, but I know they'll certainly be very useful when they do arrive, and interest rates we'll speak about as well. So this is a flow chart, and I appreciate there's a lot going on in this slide, but it is a flow chart that's put into module 10b that hopefully will bring charities through the journey of, I have a lease, how do I account for a lease, and the various questions that you need to be asking as a charity to get to the right accounting solution. So I guess I'm not sure if my pen is working here. It'd be handy if it was. I don't think it is. But anyway, if we start at the very top, does the charity have an agreement to use an asset that belongs to somebody else for a period of time? And I guess the fact that you're in Module 10B and you're talking about leases, the answer to that is almost always going to be yes. So then if we go down to the next question, are the rental charges very small, peppercorn, or of nominal value, or is there no payment made by the charity at all? And some charities will have peppercorn leases in place, and where you have a peppercorn lease in place, and this slide looks at 2 examples of leases whereby you're paying less than the full market value, but the accounting treatment is very different. So we're just looking at the left-hand side of the screen for the moment. We'll come back to the right-hand screen when we move down the flow chart. But where we have a peppercorn lease in place, and this is obviously a lease whereby you're getting an asset or you're getting something that you're leasing. There's a lease agreement in place, but any consideration that you're paying lacks any economic substance. So you might have a £10 lease, a £100 lease for a year, and I suppose that's just purely to ensure that there's a lease in place. So the SORP clarifies that a peppercorn lease is unlikely to meet the FRS 102 definition of a lease, and as a result, these will be out of the scope of Module 10B. However, you would be required to consider the non-exchange transaction element and account for that under Module 6. So you'd have to consider, okay, what benefit are we receiving in? You'd probably have to look at the annual benefit and account for that under Module 6. But for the purposes of leasing, this wouldn't be brought onto the balance sheet. And the payment, small as it may be, that's required to be treated as an expense. So whatever your £10 or your £100 a year would be expensed in the year in question. So assuming that we're not dealing with peppercorn lease, we move down our chart, and the next question then is: does the agreement have the features of a lease as described in paragraph 10B.23? And what does that mean? So the SORP and FRS 102 is very clear as to what is a lease, and there's a whole series of criteria. And I suppose if you're looking at these and saying, okay, well, my lease doesn't necessarily meet this criteria, well, you need to be considering, okay, do we actually have a lease in place, or is this something else? So what does a lease typically have? Well, there's typically a contractual agreement between parties for the use of an identified asset. The contract may specifically identify an asset, or the asset might be implicit when it's made available. So we might have a lease to lease a car or a Nissan Qashqai or whatever the case may be. But the reg number might not be on that lease. But when the asset is made available to us, it's quite implicit what we are leasing. The lessee must have the right to control the use of the asset. So the lessee must be able to direct its use and obtain substantially all the economic benefits from that asset. So if you have any funny clauses whereby you're leasing an asset, but the lessor can direct how you use the asset, or they can say, well, some of the economic benefits, I want some of the profits from that. Well, you need to consider, okay, do we actually have the right to control the use of the asset here, or does the landlord still retain all the control? There'll usually be a commencement date when control is obtained over the asset, and there'll usually be a period of use, which almost always is expressed in terms of time. So whatever, a 5-year, 10-year asset, or whatever the case may be. And ultimately, the payments are due by the lessee to the lessor for the right of control over that asset. So again, if you find that you have something quirky in your lease and that it doesn't quite meet all of those criteria, well, you should be consulting paragraph 10B.23, and then it might be the case that you don't actually have a lease as defined under the standard. And if we keep going down through the options here, so does the arrangement have a maximum term of 12 months from the date it started? So there's a short-term lease exemption. So if you have a lease that's for less than 12 months, well, then you don't have to bring it onto the balance sheet. You can just expense it as you normally would. So just watch out when you have a lease. If there's a purchase option present, well, then you can't treat that as a short-term lease. So if you have a 12-month lease with an option to purchase it at the end of the lease, well, that can't be classed as short-term because there's a purchase option present. Just while we're on that, just when you are considering the lease term, you need to consider break clauses and termination clauses. And if you have one of those, there's a few additional considerations that you need to make just to determine, well, what is the actual term for accounting purposes for this lease. And as we work our way down through this flow chart, so is the arrangement is the underlying asset of the arrangement of low value. So another useful exemption whereby you don't have to bring the asset onto the balance sheet is if your asset is classed as being of low value. So the standard, either FRS 102 or the SORP, doesn't actually give you a monetary amount, and it doesn't say, you know, below X amount and it's considered low value, but it does give an example of some types of assets that are typically not of low value. Now, I appreciate a lot of these assets certainly wouldn't be appearing on the books of a charity, but these are the type of assets that the standard calls out as typically not low value. So things like cars, land, buildings, factories, buses, all that type of stuff. So again, it typically should be fairly obvious as to whether something is low value or not. And then I suppose if we look at the flip side of that question, what could potentially be classed as low value and could potentially then not be brought onto the balance sheet and could be expensed as a result? And I guess there's a big asterisk to this slide in that a lot of these aren't actually listed on the SORP. I think a small number are listed on the SORP, but I guess judgment is very important when you're looking at low value items. You know, I see an example of a coffee machine on the screen. You know, the coffee machine you might have in your kitchen will be of significantly lower value than the coffee machine that might be in your local barista. So again, there's just a bit of judgment to be applied there when you're considering whether something is low value or not. So things like your photocopiers, your hand tools, laptops, mobile phones, office equipment, that type of stuff could potentially be classed as low value, obviously with the caveat that judgment is also required. So that's two of the most useful exemptions, the short-term and the low-value lease exemption. And if you've got this far in the flow chart, you're likely bringing an asset onto the balance sheet. And I appreciate there's a bit of a journey to go here before you get to that point. But then the final question is, based on the information readily available to the charity, are the lease payments significantly below market rents? And this is where we go back to our first slide here and the concept of a social donation lease. So we spoke about peppercorn leases, which are leases where you're effectively paying nothing. Alongside that, you might have a lease whereby you are getting a property, you're still paying something meaningful for that property, but it's significantly less than the market rents. And you know, some charities are fortunate enough to you know, have a landlord who, because they're a charity and because they're, you know, carrying out charitable activities, the landlord accepts the lower market rent. And I guess there's philanthropic intentions, I think is that the word in the slide, which is a very hard word to pronounce. So where that happens, you'll have a lease that you're paying something for, but there's also a non-exchange component, and you need to recognize the non-exchange component, and you need to increase the right of use asset, which is the asset that you're bringing onto the balance sheet for your lease. You need to bring that onto your balance sheet, and you'll have a lease liability that's lower than the right of use asset. So you'll often, when that happens, you'll often recognize income in relation to this at the commencement of the lease, just to reflect the fact that you're getting there's a non-exchange component to that lease. So that's our flow chart. I appreciate there's kind of a bit in that, but hopefully that explains, or it helps to explain. I mean, there's a lot more reading behind all of these stages, but hopefully that explains some of the ways in which you can avail of an exemption from bringing something onto the balance sheet. And if you do have to bring something onto the balance sheet, how might you do that? So just moving on then, oh yeah, sorry, just I suppose before we move off leases, just to flag a couple of specific lease considerations, particularly for charities. And I'm not going to go into these in a huge amount of detail, but just to flag some of the things that I don't think might require a bit more thinking in relation to charities. So do you have any rolling leases or leases with no specified end date? So if you have a charity that maybe moved into a property 5 years ago, they've signed a lease agreement. There might have been a natural end date for that lease, but when the natural end date ended, the payments continued and the lease is effectively rolling. So just consider, okay, well, what are the legalities of this? And I guess are you still required to bring that onto the balance sheet, even though the lease the legalities of the lease have ended, but the lease has continued to roll after that date? Peppercorn leases and social donation leases, obviously there we've gone through them. So just if you find that your charity is paying less than the market value, is it a peppercorn lease? Is it a social donation lease? What's the market value for that lease? If we were to pay full market value. Another important topic for leases is the interest rate. So when we look at leases and when we bring them onto the balance sheet, we have to recognise the present value of those lease payments on day one. So you have to recognise the time value of money when you're bringing your asset onto the balance sheet, because that asset will sit there for a number of years and it'll waste away as in line with the lease term. In order to do that, you need a rate to present value the lease, and there's a hierarchy within the standard whereby, first of all, you must consider the rate implicit in the lease, which I guess from my knowledge, there's rarely ever a rate implicit in the lease, but that is the requirement. If there's a rate implicit in the lease, you use that first. Assuming you don't have a rate implicit in the lease, you need to consider, okay, well, what's our incremental borrowing rate? So if we have any borrowings, what are we paying for our borrowings? And obviously, a lot of charities won't have borrowings because of the way, I suppose it's the nature of that. Sometimes it's not common for some charities to borrow. If charities haven't any borrowings, well, you need to consider, well, what's our obtainable borrowing rate? So if we have, if we were to go to the bank and if we were to look for money, what would we pay to get whatever funds we would require? Again, some charities might find it difficult to get an obtainable borrowing rate. Some charities might be constitutionally prohibited from borrowing. So as a result, then the final fallback is, if you were to put that money on deposit with the bank, what rate would you earn by putting that money on deposit? So there is a hierarchy there that you can use in order to determine your present value on day one. Another thing just to be aware of, just be mindful of any conditions that are imposed on the charity regarding the use of an asset. So we mentioned earlier about a landlord who might be willing to accept 50% of the payment in order to, because they're happy to lease the asset to a charity compared to if they were to lease the same asset to a member of the public. But just watch out if there's any funny kind of conditions imposed on the on the asset. So if you've got a motor vehicle and the condition is, well, you can't leave a certain region with the motor vehicle. If you're leasing out a function room and you can't serve alcohol in the function room, or some condition that might be imposed on the use of the asset. And the important point to consider there is, well, what's the market value of that asset really? I mean, if you were to impose that condition, does that reduce the market value of the asset? And I suppose just to consider that. And we've already mentioned how to account for the non-exchange component. And finally, just transitions. There are some transition reliefs within FRS 102. The SORP doesn't say very much about transition. So when you first apply the rules, but there is a retrospective approach that you can apply. So you put your adjustments to your opening equity on day one, so you don't adjust your comparatives, and there are some practical expedients there as well. So just consult FRS 102 in relation to that. I think it's in section 1 of FRS 102 deals with all of that. And getting there now, conscious of time, we've 10 minutes, but it should have everyone back by 2 o'clock. So statement of cash flows. I've mentioned tiers a couple of times at this stage. So the threshold at which cash flow statement is required has been increased. So now there's only a cash flow statement required by tier 3 companies. So that's companies with income of 15 million or over 15 million pounds, 15 million euros. So that previously was 500,000. So there'll be a lot of charities that previously had to prepare a cash flow statement that will now be exempt under the new SORP. There's one important override on this, or one important caveat on this, in that this can't override any existing requirements that you might have to prepare a cash flow statement. So if you happen to be below tier 1 or tier 2, but you happen to be a charity who doesn't meet the definition of a small entity, well, that doesn't override your requirement by company law to prepare a cash flow statement. And of course, the option is still there to optionally prepare a cash flow statement as well, if you so wish. Right, so preparing for implementation, I guess it's important to note there is still time. We've kind of only scratched the surface here today in relation to what's actually changed There is quite a bit in there, but there is still time. The first annual reports in relation to this likely won't be finalised until 2027. But as I've said in the slide, don't ignore it now. Certainly incorporate it into your CPD plan, which everybody here today will have done so. But do discuss it with your charity clients. When you're doing whenever you're communicating with them or doing your year-end accounts, just I suppose just try to identify which charities are impacted the most. So if you have charities with multiple income sources, some of that will be exchange transactions, some will be non-exchange transactions, some will be there might be contracts in place to provide certain services for a certain period of time. So just make sure that try to identify which charities might be impacted the most. And same thing with leases. Can they actually locate all their leases? They can often be quite hard to find. I mean, they're signed on day one, and they can be quite hard to find after the event. Discuss the prompt questions with trustees, or if you are a trustee here today, obviously review them and just consider them in terms of, well, what could we be including in our trustees annual report that maybe we're not including now, but certainly to take those prompt questions out of section 1 and review them. For December 25 year ends, I've kind of already alluded to this, but carry out an impact assessment for your charity clients. Just so if you're a charity here today, or if you're an accountant in practice, just so I suppose everything is clear and that it's well flagged in advance, because you don't want to be there at the last minute, not having a lease, or not fully having the sales contract or not having a grant agreement. I suppose just to have everyone pre-warned is always a good approach. And just be mindful as well of the exemptions available. So we spoke about a lot of those when we were talking about leasing and the various transition approaches. There are some ways in which the transition can be made quite easier through the form of practical expedience or through the retrospective approach as well. Finally, just before I hand back to Gareth, the slides, when you get them, there are a couple on this page, there are some links, so just feel free they should be clickable, and you should be able to click through to the various websites. So there's a copy of the SORP, which is up there, and just be aware that the 2019 SORP is still relevant, as I've already mentioned, so just make sure that you're using the right version, depending on your year end. There's a summary of changes, which is a document that was issued by the SORP making body. The SORP making body as well had a launch webinar, so I think that's that link there you should be able to click through to it. I think it's a YouTube link, so it should be fine to click through to. And the SORP making body as well have their knowledge hub, which there's not too much up on it yet, but I think they are going to be putting information up onto that in the not too distant future. Don't forget FRS 102. As I said, this is all anchored on FRS 102. So if SORP doesn't have the answer, well, FRS 102 should have the answer. And there are some fact sheets as well, particularly two that bring you through the new leasing requirements and the new revenue recognition requirements as well. So just be mindful of all of those. And so hopefully I have covered quite a bit there. And I suppose before I hand back to Gareth, just thank everyone for attending. I know we've a good crowd on here today, so hopefully it was beneficial. There's a lot to unpack in the SORP, but hopefully that gives you a flavour of some of the changes that are coming down the track. And of course, wishing everybody a very happy Christmas, and hopefully it's a nice break for everybody, and hopefully it's a peaceful time and a happy time for everybody. Back to you, Gareth.
Hey, Mike, look, thanks a million. That's been extremely helpful. I'll probably make a couple of observations rather than questions, if that's okay, Mike. I think we'll all be running off looking to identify the tiers of our various clients, and looking at what is must and what is should and what is may for the various ones. And the leases, that's an interesting flow chart that'll I think everyone will reflect on that as well, just to help us. And then the knowledge hub, I would say, in not too distant future, that'll be well utilized to help us all get up to speed with the new developments in the SORP. So they're just my initial observations, and I just wanted to say thanks a million, Mike, for taking the time, and it's very, very comprehensive. presentation there. I'm conscious of the time, and I do like to keep it strictly within the hour, because we appreciate that people have many other things to get on with. So I just want to echo your thanks to everyone for attending, and also wish everybody the very best over the Christmas period. And I'm going to say a SORP inspired 2026, and everyone the very best wishes for the year ahead. So thanks a million, everybody.